Welcome, fellow consumers, to Consumer Math Lesson 3.3 Payroll Deductions. Our objectives include calculating FICA withholding tax, federal income tax, and state income tax. FICA, which stands for Federal Insurance Contributions Act, is 7.65% of an employee's gross pay. This is the first deduction sent to the government. 6.2% of that goes to Social Security with a maximum of $132,000 of your pay being calculated. And 1.45% goes to Medicare with no income limit. So that means if you make above $132,000, once you get above $132,000, during the course of a year, then you don't have to pay Social Security percentages after that, just the Medicare percent. Now, the federal income tax is based on your income level, with the more you make, the greater the percentage deducted and sent to the federal government. So someone who makes $30,000 a year is not going to pay as large of a percentage as someone who makes $60,000 a year. State income tax is calculated according to state laws. Some states have a flat rate where everybody pays the same percentage regardless of how much money they make. Some states have a similar structure to that of the federal government where the more you make, the larger the percentage you have to pay. But some states, like Tennessee, do not have a state income tax. It is up to each state to determine what the tax is or even if they will have one. In example 1, we're going to find the payroll FICA deduction for Sophie Holland. She has a biweekly gross pay of $870. So that means that she gets paid biweekly. That's every other week. So she has 26 pay periods per year. That's going to be important later. So remember that. We're going to find her periodic payroll deduction for FICA. Well, FICA is 7.6%. I'm sorry, 7.65% of whatever your gross pay is. So it's 7.65% times gross pay. Let me just write gross pay here so you can remember the formula. And that is your FICA calculation. Okay. So let's find 7.65% of her $870, and that will be her FICA deduction. So we're going to convert this into a decimal and say 0.0765 times her base pay of $870. Let's put that in the calculator. And we get 0.0765 times $870. That is going to round up. Remember, we always round to money to two decimal places. It's going to be $66.56. So $66.56 is her FICA deduction. Every time she gets paid, she has to pay this amount to the federal government. Let's look at the next example. So in example 2, Sophie Holland is single and she has claimed one allowance. What the heck is an allowance, Ms. Tracy? All right, so that's one of our new words, our vocabulary words. And the amount of income tax an employer withholds is based on the number of allowances. Think of allowances as the number of people you're supporting, the number of dependents, the number of people who depend upon your paycheck. So in this case, Sophie Holland is single, so there is only one person depending upon her paycheck, and that's her. So there's one withholding allowance. You're going to want to be accurate when you tell your employer how many allowances you have. And you'll do that whenever you get hired or whenever you have a life change, like you get married or you have a baby, the number of people who are depending on your paycheck changes, right? Now, if both you and your spouse work, if you get married, that might not change. You might still just have one deduction if he is taking or she is taking one deduction from her employer. So that, may not change when you get married, but it will definitely change when you have children, whether you have them or adopt them or whatever. It doesn't matter. One of you gets to claim the child on your payroll. What's important is that the total number is the total number of people in your household. So if you're both working and you claim one and you have 2 kids and your spouse claims themselves and the 2 children, the total number is 4. You could claim a child and he could claim a child, or she could claim a child, whoever your spouse is. As long as the total number of deductions for both of you added together is the total number of people in the household, then your taxes at the end of the year are going to come out correct. You're not going to have this large amount that you owe the federal government, and the federal government is not going to have this large amount that they owe you if it is correct. And I highly recommend that you don't undercount, because some people will undercount and say 0 withholding allowances, and then the federal government just holds out the maximum amount, and then they get a refund when they do their taxes. The problem with that is the money that you're paying the government during the year, you're kind of treating the government like a savings account. There is no growth on that money. You could take the amount of money from each paycheck that you would have normally overpaid and put it into an interest-bearing savings account and grow your wealth. When you give it to the federal government, they do not give you any interest back. So it's just a flat difference. It's smarter to invest that difference. So be accurate when you fill out your W-4 form. Whenever you need to make changes to it, be accurate with that so that you can be smart with your money. So let's look at example 2. Sophie Holland is single, claimed 1 allowance. Her gross biweekly pay is $870, just like before. We're going to determine the amount of federal income tax withholding. So she's withholding for one person, which is seen here. This is just a section of the entire tax table, just the part that pertains to Sophie being single with 1 allowance. And then she's going to look under the 1 withholding allowance column and see her pay schedule. And her pay schedule is biweekly. So this is the one she's going to look at. That biweekly withholding allowance is $161.50. So that is literally what it means. It's a withholding allowance. So we can take that much out of her base pay, her gross biweekly pay, and that is the amount of taxable income that we're going to look at on the tax table. So the withholding allowance table tells us how much we can withhold. So that would be minus $161.50. And we're going to do that calculation with a calculator. Imagine that. So $870 minus $161.50 is $708.50. So this is the amount of what we would consider taxable income. So we're going to look at this amount on the tax table and see where that falls so we can find our appropriate tax rate. And if you look, it is between $519 and $1,664. So this is going to be the appropriate tax rate, and it is for the amount over $519. So we're only going to be taxed on more than $519 of this amount. So we can subtract $519, and I'm going to pull up my calculator since I know that this is still here. I'm going to subtract 519 from that, and that gives me $189.50. So the taxable amount is $189.50. So for that, I've got to apply this formula. So it's going to be $37.30 plus 12% of this amount. So that is exactly the calculation I'm going to write. $37.30 plus 12% translates into 0.12 as a decimal times 189.50. So when I do that calculation, I'm going to do this part first. That'd be 3730 plus 2274. And when I add those two amounts together, I get $60.04. So that is my federal income tax, or my FIT deduction. That's how much is going to be deducted from Sophie's paycheck for federal income tax. So now we're going to look at her state income tax deduction. So in example 3, we're going to find Sophie's state income tax using the below table. So we know already that Sophie makes $870, and that is bi-weekly. So that is 26 times a year what she gets paid. She gets paid a gross $870. So states differ on the methods that they use to figure state income taxes. The most common methods are a flat tax and a graduated tax. And a graduated tax is like what we did with the federal income tax deduction. Based on the amount of money you make, the percentage changes. So typically, the more money you make, the higher the percent that you pay. So we're going to look at how to find Sophie's state income tax. Now, her state has two rules that go along with the tables that they put out. And the first rule is that per allowance, you have a 2440 personal exemption. So that's a personal exemption. That means that she can deduct that from her gross pay. So that's the first thing we're going to look at. We're going to take that away from her annual pay. But first we have to figure out her annual pay. So if she gets paid $870 26 times a year because she's biweekly, that's what we're going to do. We're going to multiply that times 26, and we find out that she makes $22,620 per year. That is her gross pay, her annual income. Now we're going to deduct the allowance, her personal exemption. So $2,440 is going to come off of this annual income. So we subtract that, $2,440 from $22,620. And I'm just going to use my calculator because, God made calculators for a reason. And this is one of them. $20,180. So $20,180 is her new taxable income. So now we're going to find the standard deduction. A standard deduction is what the federal income tax and your state income tax will sometimes have what's called a standard deduction. And it's what they allow you to deduct if your expenses are below that. And this is per allowance. So because she's just got one person that she's supporting, there's only one allowance here. Or at least one allowance here. So 10% of the gross up to $31.50. So her gross pay is this amount, the annual here. So we're going to multiply that times 10%, which is a decimal 0.1, and that's going to give us $2,262 is her standard deduction. So we can take the standard deduction and subtract it from the taxable income after the personal exemption. So we're going to subtract that, and that is going to give us her total taxable income. So minus 2,262, that is 17,918. This is her final taxable income amount. So now we use this amount to look on the tax table and figure out what her tax rate is. And 17,918 is more than the maximum, which is 11,450. So this is the tax rate that we are going to use. And it says 7% of the taxable income minus this dollar amount, $357.24. So we are going to write our calculation exactly this way. We're going to turn 7% into a decimal, so it's 0.07 times the taxable income, so 17,918 minus 357.24. So when we multiply this, let's see what we get. We multiply that times 0.07 to find the 7%. We get 1,254.26. So 1,254, and did I say 26? Yes, 26. And we're going to subtract 357.24 from that. Okay, so minus 357.24. So 897.02. That is how much she owes on this much pay to her state every year. But she has 26 paychecks a year. So we're going to divide that by 26 to find out how much she has to pay per paycheck. So we divide that by 26. She has to pay $34.50 because this only rounds, it doesn't round up to 51. $34.50 per paycheck to state income tax. So let's look at all of her deductions so far. She started out with $870 of base pay. So for FICA, we had to deduct $66.56. That's her FICA tax to the federal government for Social Security and Medicare. So let's just start calculating. $870 minus her FICA, that's $803.44. All right, now we have to subtract her federal income tax. And her federal income tax was $60.04. That's her federal income tax. So when we subtract her federal income tax from that balance, we have $743.40. So $743.40. Now we have to deduct her state income tax, so minus $34.50 for state income tax. And when we take that away, we get $708.90. And that is what we call her net pay. And your net pay is the amount after FICA, federal income tax, and state income tax if your state has it. That's how much she gets to bring home if she has no other deductions like 401k or health insurance or employee stock purchase or anything else like that. If she doesn't have any other deductions like that, then this would be her bring home pay. But you can see that almost it was about $162 that, or $161.10 that is in taxes before she even gets to spend any of it. So let's look at our last example problem. In addition to the deduction for taxes, payroll deductions commonly include health insurance and retirement plan contributions. The cost of employer-sponsored health insurance plans is shared by the employer and the employee, so it cuts the cost of the employee. So whenever you have the opportunity to participate in health insurance provided by the employer where they will match it, take that up, take that chance, because your health insurance, you'll get greater benefits for less money when you have an employee match health insurance. Many companies also sponsor retirement plans that you can participate in through payroll deductions, which means that you're going to take a little bit of your pay pre-tax before there's any tax. So it reduces your taxable income. And you're going to take a little bit at a time each week or every paycheck, whenever that paycheck period happens, and you're going to contribute it to a retirement plan. This grows with interest. So it's a smart way. If you don't have a money market account or CD to put that extra money that you would have put into getting a refund from the IRS, this is a smart way to take that money and put it into an interest-bearing retirement plan so that your money is going to grow. And the longer the money is in there, the more it grows. So over time, when you're ready to retire, you have a nice nest egg, so you don't have to worry about how you're going to pay the bills when you don't have a job anymore. You'll have cash, like a fund that you can draw from that will last you well into your golden years. So that is what you want to do. If you have the opportunity to do a 401k or an IRA or some type of retirement pension plan, you want to donate that. Even if you change jobs, a lot of times those plans will roll over to the next job. So participate in those when you get the opportunity. So let's look at example 4. We're going to assume all of the tax tables that we've worked with are going to be the same. So we have the withholding allowance for the federal income tax. We have a new table. This is for weekly married. And then we have the example 2, the example 3, the state table. And we're going to use the same rules that particular example state set up for withholding and standard deductions as well. So the first thing we need to figure out is FICA. So we're going to determine our FICA, and that's fairly straightforward. Remember, FICA is just 7.65%, so 0.0765 times the base pay of $840. So that's going to be, when we do that calculation, that's going to be $64.26. So there's our first deduction that comes out of our pay. Now let's look at federal income tax. This is going to be our federal income tax calculation. So remember, first we've got to subtract the withholding allowances to determine our taxable income. So we have withholding allowance here, and weekly, which he gets paid each week. So we're going to do the weekly withholding, but there are 2 withholding allowances. So we're going to take this and multiply it by 2. And when we do that, actually, I'll just write this right here, times 2, that's going to equal, get my calculator, 80 times 2 is 161.60. So 161.60 is his withholding allowance to come off of his federal income tax. So we're going to subtract 840 minus the 161.60. And when we do that, 840 minus 161.60 is 678.40. So 678.40. Now we're going to use this table to find the tax rate for the federal income tax. So this amount right here is what we look here in this table, and it's $678.40. So we see that that's going to fall within this range. So we're going to use this tax rate for anything over 600. So we have to reduce this by 600. So minus 600, that's going to leave $78.40. So now we're going to apply this tax rate to this amount. So let's write that out here. $37.30 plus 12% times this $78.40. And let me pull up my calculator. And when I do that, let's see, 37.30 plus 0.12 times 78.40 equals $46, and we're going to round that to 71 cents because we always round to 2 decimal places when it comes to money. So 46.71, that is going to be our weekly federal income tax. Remember, this is weekly, this is weekly. This is what comes from FICA and federal income tax. Those are the deductions taken off of the weekly paycheck. Now let's do state. State, we've got to figure out the annual, and then we figure out the weekly. So our state income tax, that's this over here, that is going to equal the gross annual minus the withholding minus the standard deduction. And then that's what we'll use to find our tax rate. Okay, so let's do that. First of all, we got to find the annual. And the annual, he gets paid every week $840. So that's going to be 52 times $840. That's going to give us his annual salary. So when I pull my calculator up and I do that, 52 times 840, I get $43,680. So his annual salary is $43,680. Okay, so now we can deduct the state withholding per person, and he's got 2 withholding allowances here. So for the state, we're following the rules set forth by the state, and that's going to be $2,440 per person. So $43,680 minus 2 times that amount, 2,440. That's our first step. So that's going to be, let me get my calculator. 43,680 minus 2 times 2,440 equals 38,800. So 38,800. So that's after the state withholding per person. So now we have to apply the standard deduction, which is 10%. So 38,800 times that 10% is equal to 3,880. But the maximum is 3,150. So that means that we are just going to subtract the maximum because this is above that. If this is the max that we can allow for standardized deduction. So we are not going to subtract this because it's more. Instead, we will, I'm just going to cross through that so you can see we're not going to use that because it's too much. We're going to just subtract the standard because maximum, because that is where the numbers, that's what this equation tells us. 10% as long as it's less than or equal to $3,150. If it's more, we just use $3,150. This is the maximum we can use. So now we're going to subtract that. So minus 3,150. That leaves $35,650. So $35,650. That is now the taxable income. So if we look over here on our chart, we see that it's above $11,450. So this is going to be the tax rate that we need to use. So we're going to use this amount. Let me go ahead and erase this now. We're going to use this amount to determine our tax rate. So we say $35,650. That is times 7%. So 7% times that amount minus $357.24 is going to be equal to our annual tax bill to the state. So let's do that calculation. All right, so that amount times 0.07 minus $357.24. $2,138.26. Okay, $2,138.26. This is the annual tax bill. He gets paid weekly. So we have to divide that by the number of weeks in a year. So that's going to be 52 weeks divided by 52 weeks. So when I take that amount and I divide it by 52 weeks, that's going to be $41.12. So $41.12 per week is his state income tax. So that is the amount of state income tax. So now let's look at all of those deductions. So we start with $840. Okay. Now we're going to subtract FICA. FICA was $64.20. So minus $64.26. That's FICA. Okay. So let's do that calculation. 840 minus 64.26 is 775.74. All right. Now we did that one. Now we have to subtract federal income tax. So it's 46.71. So minus 46.71. That's federal income tax. So now we subtract that. Minus 46.71. That's 729.03. So 729.03. Now we have to subtract the state income tax. So minus $41.12. That's the state income tax. Minus 41.12. So that's $687.91. So $687.91. Now we also are deducting $75.60 for health insurance. So minus $75.60 for health insurance. So let's subtract that and see what we have. So minus $75.60. So now we have $612.31 is his take-home pay. That is the amount he gets to keep every week. So you see how all those taxes and deductions, they add up. He started out with a really nice paycheck, but because of the taxes and then the health insurance, he brings home about 3/4 of what he earns. But the reason we do that, the reason that we do federal income tax and FICA and state income tax as we get paid is because it has been, found over time that people typically don't have the self-discipline to put aside that money every week to pay a once a year tax bill. So instead, they take it gradually from your paycheck as you earn it. And then at the end of the year, people will do what they call taxes, and they tally up and they make sure that you've paid in the right amount. Or, maybe the government has received too much, because it's your employer that takes the money out, does the calculations, and sends it in. So maybe your employer made a mistake, sent in too much, or maybe you withheld or you claimed no deductions and they withheld the maximum, right? So then you paid more taxes in, even though you didn't have to. So then you would get some back. Or maybe you didn't pay enough. Maybe something didn't happen right. Maybe you claimed more deductions. So you wouldn't have to pay as much in each week. Well, then now you've got to pay some in at the end of the year. So it's really important that you do that W-4 correctly and get a little self-discipline to make weekly contributions to a 401k or an IRA or some type of independent retirement account, so that over time, your money has time to grow. If you don't start worrying about that until you're 30 or 40, then guess what? You're not going to have enough money to live on once you're over the age of 65, which is retirement age. You're going to be short. You're going to come up short and be stuck depending on your children to help take care of you. And then they have to take care of their families and their parents all at the same time. And that's not fair. It's not fair to them. You want to be able to stand on your own 2 feet, even in your twilight years, and have a nest egg that pays your expenses. And then maybe you might have a little bit of money to leave your children once you're gone from this world. So think ahead, plan ahead. You want to be able to live without having to worry about every penny. So make plans now to do that. It's good advice, whether you take it or not. It's good advice to plan well. All right, so that's all we have for lesson 3.3. I will see you in lesson 3.4. Be sure to do those practice problems.